held the CFO position since 2018 and joined the company back in 2010. Jeff, as CFO, you've clearly been on the front lines of the right sizing of the cost structure over the last several months, so I'm looking forward to getting your perspective on that. And like the other panels this morning, I'll have you open things up with your key messages and how you're feeling about your relative positioning in the current markets, and then we'll drill down from there.
Excellent, thank you, and good morning, everyone. Yeah, it's been an interesting couple of years, and in particular, I'd say the last probably 6 months. But I want to leave everyone with is, I think what they've seen from us here in late through in Q1 through this quarter is, given we have the offshore business in China and our integrated corridor with basically our finished products selling right at the rack in Pad 2 in Ohio primarily, we really took what I'd say is we call early and swift action. We could see the demand impacts early on, I think, relative to folks who didn't have that integration and took that real-time feedback. And what I want to leave folks with is we did this in kind of a three-planked approach, right? And the first plank was really, as you kind of alluded to, is we reduced our CapEx by 50%. We cut, from $3.2 billion down to $1.6 billion. And really that was, we could see the demand reductions and recognize the price signals and cut back and prioritized, obviously, the balance sheet through this. And that was really, focused on the big dollar impacts really were, suspending, or what I would say is deferring the West White Rose development a minimum of a year, cutting back on our thermal developments and halting new projects and kind of shaping the sustaining capital, and then really halting any remaining development that we had in Western Canada and what our more conventional heavy oil business. We are still finishing and completing the 29-1 field, given the gas price here and where we are in the project. And that project is going very well, and we expect that to complete in Q4 here. And so really took that early action on the capital to prioritize the balance sheet and recognize the price signals. And then the second plank really was optimizing and getting the value out of the integrated corridor and that integration. So we took early action and constrained or shut in production of around 80,000 barrels a day in the upstream portion of the corridor. And correspondingly, we took our refineries, they were down to minimum operating rates. You kind of think about that 100 to 105,000 barrels a day. And, Lima can normally run around 170,000 barrels a day. And really that was recognition of what we saw on the demand side. And it proved to be a very good decision. And ultimately we ended up being able to source cheaper barrels out on market and had less barrels on the system, either coming from a production side or sourcing into the refineries, and really optimize to that. And we continue now to bring up both our upstream and downstream production in concert with one another and in concert with where we see the end demand. And the third plank, reinforcing the priority of the balance sheet, as we continue to drive out costs out of the system. We identified, I think, and announced around Q1 $100 million in savings between exploration, OPEX and SG&A. We continue to work further cost savings initiatives and continue to work that. And then number two is we did reduce the dividend. The board made the decision to reduce the dividend by about 90%, taking it from around about $500 million a year to kind of that $50 million mark a year. And that really just reflects, and I think we've proven over time that making those decisions to protect the balance sheet through times of these and making sure that you protect your liquidity puts you in a good spot. So I think, what I want to leave folks with is really we are prioritizing the balance sheet, number one, and we continue to demonstrate value out of the value chain, and we'll optimize in line with end demand and continue to maintain discipline on that as we come through the cycle here. So those are the key messages I want to leave with folks, and pass it back to you for the questions.
Yeah, thanks for that, Jeff. So as the CFO, maybe you could just dig a little deeper in terms of where you're focusing your efforts when it comes to the balance sheet. And as a part of that, maybe just remind us of your current liquidity position. It looks like all of the integrateds got a pretty big boost through the last quarter, the debt maturity schedule, and any covenant-related considerations.
Yeah, no, absolutely. So where we were at the end of Q1 was about $4.7 billion in liquidity. Right after the quarter in early April, we were able to secure a $500 million, an incremental $500 million term loan. And that matures in 2022, and I think we're very happy with how that was executed. And really, when you think about that's important in the fact that we completed and paid down a bond maturity in March, about $400 million. We have no further maturities until 2022. So when you think about that, is you're sitting around $4.7 billion of liquidity at the end of the Q. We closed the $500 million term loan, and we have no maturities really either from a syndicate perspective or a bond maturity or the term loan really until 2022. So we're in a well positioned through this from a liquidity perspective, and took some action really just to shore up and provide further protection there, just given the risk profile that we saw. And I don't think I think anyone in industry has difficult time forecasting oil prices, let alone broader health issues on a pandemic. So I think it was important to close that, and really no maturities until 2022. And we'll continue to look at different opportunities to really, can you push out other opportunities to kind of push out your tenors and different pieces like that if opportunities are there. But we're in a very good place from a liquidity perspective. Number two is when you talked about covenants, is we really don't have any substantive covenants we see any risk or issue. We have one, let's say, broad covenant on our $4 billion of committed syndicate facilities, and that's a debt to capital covenant of about 65%. And we're currently kind of sub 30% or in and around that 30% mark. So really well positioned from a liquidity perspective. And just to remind on those syndicate lines, there's $4 billion available, like on the headline price on those lines. $2 billion comes, we look to re-up in 2022, and the other $2 billion doesn't re-up until 2024. So well positioned with the backup of those and from a liquidity perspective. And you can see our actions from the capital reductions, making sure that we really prioritized to end downstream demand and adjusted the refinery and upstream throughputs. It's really all in the event of or focus of protecting the balance sheet and liquidity through this. And that's constantly top of mind, and obviously, and we've demonstrated that through with the rating agencies as well. We're able to hold the BBB with S.
Are you still there, Jeff? Is anybody on?
Hello?
It's Menno here. I think we might have lost Jeff. I'm not sure who's on.
Yeah, we're
back on. We're back on.
Can you hear us?
Are we live? Yeah, I can hear you fine.
Oh,
Are we
good, excellent. I hope it wasn't something I said. So I don't know where we were left off.
I believe you were mid-sentence on on covenants. Yeah, we're on the balance sheet.
Excellent. Yeah, no, on the covenant side is we do have what I'd say is one covenant on the demand on the syndicate lines, the committed facilities, and it's really a debt to capital covenant. The target is, or the covenant is maintained of 65%, and we're currently right around the 30% mark of that. So well within range, and don't see any issues with that. And just to highlight those two, the max available on those two lines is $4 billion. And we've staggered it. $2 billion we'd look to re-up. It comes in 2022, and the other $2 billion in 2024. So really balanced out the risk there, and in line with our bond maturities. There's really nothing from a liquidity or maturity perspective in the next kind of year and a half or so, right? So we're well through 2021.
Okay, and just to to go back to the budget, again, you cut it by 50%. TI is north of $40. Is there any temptation to re-accelerate some of the activity that got pushed a few months ago?
No, I mean, talking the remainder of this year I don't see that regardless of price. When you think about where we cut the CapEx, I'll start with the offshore. So we are completing the 29-1 development. That will continue on. In the Atlantic region, we did cut back or defer a minimum of a year the West White Rose project. And really the decision point there is think of that as in year block increments. And so really there would be no change to that, and the decision is really around next year and beyond. And then if you think about the rest of it, primarily came from thermal capital reductions, and our focus really on there is kind of driving out cash flows out of the integrated corridor and the value chain, and we're not in a headspace really to really adjust that CapEx frame out. We're comfortable with what we've got in front of us over the next year here, over the rest of this year, and I don't see us ramping up regardless of oil price here in the latter half of the year. Amen.
Hello?
Oh, sorry, I was on mute.
Okay, good.
Yeah, this is
I'm really pissing you off.
Right? Yeah.
What's that?
So, sorry, just the question related to the 80,000 barrels per day of shut-ins that you alluded to. I'm assuming based on commentary from other producers that most of this has been brought back online, but maybe you could just give us an update there, and then as a follow-up to that, just remind us of how much of that total may never come back online and the rationale for leaving it in the ground.
Absolutely. So, from the start is really dependent upon, end demand. And like I said, we're managing the refineries in concert with the upstream. At a peak, we had 80,000 shut in or constrained. We're probably right now at this time around 40,000, shut in or constrained. And even from the start, it was really dependent upon that end product demand, but we kind of viewed it as a Q2 phenomena. As we got through the major impacts of the economic shutdown and demand impacts related to the COVID lockdowns there. So we're around 40 right now, and I'd expect us to really kind of continue the ramp up here, both at the refineries and the upstream, because we look at that on an integrated basis, and really to be through the shut-ins here in kind of July and August, and kind of back up to full rates. And you asked about how much of that wouldn't come back on or what's permanent. It's probably about 5,000 barrels a day, and it's really the way to think about that 5,000 barrels a day. It's really in our conventional heavy oil production. It's really your higher cost OPEX production, and really the go in to restart it and the like, and just with you have sometimes degradation on the wormholes through in the reservoir, and so that's really factored into the decision. It's really reservoir dependent in around the coal production side, and you're probably talking about 5,000 barrels a day. The residual of it is really just in the thermal space, both Sunrise, Tucker, and our Lloyd thermals, and we don't expect any long-term impacts there, and would ramp that back up and be through all of the constrained production, both in the refineries and the upstream here in early Q3.
Okay, and then if we flip over to the Superior refinery, clearly we're seeing a pretty big resurgence of infection rates on the COVID-19 side of things. So is that affecting the rebuild? What is your best guess on a revised timelines? And maybe you can just also remind us of the rationale for buying the asset to begin with.
So I'll start with the rationale, work my way from the history forward. We at the time obviously had, we were wanting to maintain significant integration and heavy oil processing capacity relative to our thermal growth and heavy oil production. And so we are evaluating whether we would double up the asphalt capacity at the time in Lloydminster, and this opportunity came along on Superior that provided a demand sink. I think it was, probably 20,000 barrels a day of heavy. We can now, I think when we do bring it back on, closer to 25,000 barrels a day of heavy. And it was really, at that point, as a really make versus buy decision, number one. And at the time frame is when we could get it, you secured that capacity at the time where we saw the biggest risk with egress and the like. So it really provided that opportunity for us to, I think, on a per barrel basis, really replace some organic things we were looking at. Number one, and you kind of look through now where we're at now is clearly we said we'd be closer on kind of around the back half or end of 21. We haven't provided a full date here because obviously what you talked about is it's dependent upon how we get back in the ramp up and the like, and so we'll update in due course here. But that would be moving you more into 2022 timeframe, and we'll update fully when we're actually have line of sight as we bring everything back on. We've started some a little bit of work, but we've been very prudent and thoughtful. I would expect if things progress in the area we're in, because we're, remember, in Wisconsin area and in Minnesota, so it's definitely I wouldn't say a hot spot, but clearly there's impacts that you have to kind of go through depending on where you're doing some of the work and the like. And so I would expect us to really kind of start to ramp up in earnest here in kind of Q3 and Q4 with that. And then we'll update in due course as we have better line of sight to that execution and any related COVID impacts. But we'd expect that to come on. Our expectation is really to come back on the development side or the construction side here in earnest in the latter half of the year, obviously COVID dependent. And we'll update once we have that, we'll really start to ramp up the construction on an updated time frame at that time. And really it's, I think a good asset. It will be a good asset for us, and remember, we do have insurance coverage that we expect through, and that's one of the reasons too. You continue on to execute in the rebuild, and and then provides that processing capacity for our heavy oil production.
And then if we move on to Asia Pac, gas pricing in that region has been a clear differentiator for you for quite some time. We've seen a really big correction in global gas prices. So what gives you the confidence that the sort of pricing that you're getting today can be maintained over the midterm? And then you touched on the 29-1 field. Is there anything that could get in the way of the startup of that field by the end of the year?
So in relation to 29-1, no. I mean, I think where we're at, we're well advanced. Obviously, the wells have been drilled and completed, and we're in the final stages of the project. And it's really, you kind of think of it as a near field tieback. It's coming back into the existing infrastructure and platform and then the onshore processing facility. So when you're thinking in the grand scheme of things is relatively lower risk. It's not a greenfield development, and it's utilizing the existing infrastructure. So very low risk, and we expect that on definitely by the end of the year, and perhaps I think hopefully we can get it earlier in Q4, but we're looking towards that and very confident in it. And as far as Liwan and the broader gas in China and the like is we did see. We talked about the fact that we saw demand impacts in China and our U.S. refineries, earlier probably than I think a lot of folks didn't have those types of businesses, and we saw, much like like we do around Christmas and New Year's and around North America, as demand kind of reduces and you have economic activity come down a little bit. We usually have a week or so in and around the Lunar New Year where you see that, and that was probably double what we saw. So it was a couple weeks. A week or two longer than what we normally saw, just simply because of the extension of those holidays, given all that was going on with COVID. But what we've seen since then, actually, is offtake and demand ahead of our assumptions in what we were laying out in the guidance. So very good offtake on Liwan and the associated fields. And what I can point to is the fact that we have had good offtake. Demand has more than recovered from where we were and is actually ahead of what we were expecting. And that's an important proof point to see. I mean, I think clearly as if there was, if you had broader issues, is you'd probably be, we'd expect probably lower offtake. We've seen very good offtake. And I think part of that is ultimately it is, domestic production, and we are, our partner is CNOOC in the field, and I think being that domestic production, I think has probably helped a little bit. So we have seen very good demand over and above, I think, what our base expectations were. And so, and that has been fairly consistent after we got out of the little bit of extension there around the Chinese New Year. So very happy with that. So 29-1 is going very well, relatively low risk project. And when you think you've drilled and completed the wells, you're utilizing existing infrastructure, very low risk to completion there. And then as far as pricing is, we're seeing demand over and above what we were kind of thinking in our base since we came out of the Chinese New Year. And so quite happy with that. And I think that's I think gives us some confidence in holding that.
Okay, I think we'll wrap this panel up with a question on a part of the portfolio that doesn't seem to get as much airtime as it used to, and that's the East Coast. Can you just give us a brief overview of the outlook for that region in terms of existing operations, and how does it stack up relative to other parts of the portfolio when it comes to competing for capital?
Yeah, so number one is there. Obviously we have two producing interests. Obviously the West White Rose or the White Rose project, inclusive of West White Rose. And the way we think about that, and this will tie in. I'll talk to what you're talking about is how we think about capital allocation. Operations are going well there. Steady operations. We did. Obviously, one of the big reductions we made this year on the CapEx was the West White Rose project, and we took that in a spot to complete engineering and we'll ramp down in a safe manner, and then think of that as minimum year decision increments and the like, and so that'll obviously come in, and I'll talk to the capital allocations. Terra Nova was operated by Suncor, was obviously scheduled to go into off station this year, actually be on right now. And go through the asset life extension and the like. I think there's obviously the operators looking at different options there and different methods. Obviously, that was impacted by COVID amongst other things. So that's fluid, but it's not a significant piece of. It's about 4,000 barrels a day our working interest. So it's not a massive piece on that, and the operators are working that, and that's really we'll come through that, I would expect, and have probably more clarity as we get into the back end of this year on just how they handle that with the asset life extension and the off station. And when you think about the West White Rose and White Rose itself, that gets really into your question on capital allocation, how we think about it, and number one is the balance sheet. And I think for us is we'd like to get the balance sheet in the spot is you're kind of trending under that kind of net debt of $4.5 billion. Obviously you have good line of sight, and what's most important is the corporate cash flow. And if we're in a lower price environment, we can get into a capex range of 1.2 to 1.4. And this is where I will think you think about number one, the balance sheet, getting it below that kind of $4.5 billion range on net debt. And you think first call on capital, you kind of think we could get to the 1.2 to 1.4 range. That's focused really on your base capital in the downstream, and then really just focused, that's about $500 million, and then you've got about $500 million really going to the integrated corridor upstream, which is really focused on our Lloyd thermals. And then after that, it really depends where your balance sheet is and where the price lines are, and we'll make a decision relative to do you further growth from there as further thermals to grow that, or versus West White Rose, and we'll evaluate that. But that's the way we think about capital, and the priority for us is the balance sheet, really sustaining that integrated corridor business in that base 1.2 to 1.4,